This is Darren with SpreadEdge Capital and the Bull Strangled newsletter. This is a performance review for the September 5th expiration cycle. This is a brief overview of the strategy. As an introduction, this strategy entails buying a stock and selling both a covered call and a cash secured put, or what some call a naked put, both of which are out of the money. The goal is to earn option premium while maintaining controlled stock risk. Here you see kind of how the trade is constructed. You can see that we're buying stock in 100 share increments, and then we are selling a call above and a put below. The range in between is kind of a style thing. People may want to keep this tight, which gets you more option premium, or you get a little looser and have the opportunity for more stock upside. The strategy combines three strategies into one single position. Obviously, the long stock, which allows you to participate in price increases. You have the covered call, which limits upside potential in exchange for receiving premium. And then you have the naked put, which generates income while creating an obligation to purchase additional shares. Now, I have 5 videos on YouTube that describe this strategy in more detail. The first one is a little less than 10 minutes, and it provides a pretty high-level overview of the strategy. And then there is a 4-video series that covers all the topics below. In total, these videos are a little less than 4 hours of content and thoroughly explains the strategy. So it starts off with an overview of stock options. It goes through then in video 2, the strategy. Video 3 is about the risk optimization elements of the strategy. And the 4th video describes the contents of the newsletter, which is published each week. You can find these videos on YouTube and search for SpreadEdge Capital. This provides a high-level overview of the core elements. Obviously, the most important part of the strategy is to pick quality stocks. And we're looking for stocks that are technically strong, using time-tested stock engine and a variety of different parameters that help us to get to stocks that are great candidates for covered call and naked put writing. We are sellers of option premium, which does give you the obligation to sell your stock at a set price and the obligation to buy additional shares at a set price. We talked a little bit about how the trades are constructed on the previous slide, but bottom line is we're buying shares in 100 or stock in 100 share increments and selling a call above and a put below. We're leveraging a weekly option cycle where we are on Monday placing trades that will expire 4 Fridays later. We are looking at the market environment and trying to be heavily invested during what we call green episodes, or times when the market is strong, and we are going to back off when the market isn't as strong. And we are very focused on diversification across sectors, across stock price, and across implied volatility. So that's a real quick overview of the strategy. As mentioned, you can go to my YouTube channel, SpreadEdge Capital, to get a lot more detail on the elements of the strategy. So we start the performance review by looking at the overall market environment. And you can see here that the stock market has been in a pretty strong upturn for most of this year. We did get a pretty big decline there in mid-March to early April, but the market has recovered pretty nicely since then. For last week, the market increased 0.3%. So, and I cover this more in the videos. This is still what I would consider a green market, which would entail being fully invested. This slide illustrates how the option premium impacts the total profit. This analysis includes 367 trades from February 2024 through August 29th. The data set is sorted high to low by stock gain percentage and then is divided into 20 equal buckets. On the left compares the stock gain to the trade gain, and recall that the trade gain includes the stock plus the options. And on the right is the same data, except it's in table form. Note that when you break this down into the different buckets, the first 5 blocks represents where the stock gains are capped by the covered calls. This is 25% of the time, and you can see that once again, you can't go above any. Once you reach that call strike price, your gains are then capped. So in this case, the stock gains were quite a bit higher than the options. The next block, which includes 6 through 11, is where the stock gains are amplified by the call and put premiums. And in each of these blocks, we see that the stock and options is higher. And of course, the same is true for blocks 12 through 15. But in this case, we actually took and turned a stock loss into a trade gain. And then the next block is where the stock lost and the trade lost, but the loss is reduced by the option premium. And then the very last block, which is 19 and 20, this is where the naked puts actually worsen the trade losses. Now, this last area is, of course, the worst case scenario, but note that that occurs about 10% of the time. Now, looking at this at a little bit higher level, we see that 25% of the time the stock gains are capped by the covered call. We see that 65% of the time the option premiums improve the overall performance, and then just 10% of the time the naked puts actually worsen the trade losses. All right, when we start talking about the different variations, I think that I tried to design this in a way that really simplifies thinking about all the different components of these different variations. Bottom line is you can trade up to 8 different strategies, which accommodates a very wide range of risk profiles. So there's really 4 strategies, but you can also add protective puts to any one of them, which then doubles it to 8. Now, the way I like to think about this is that there's really just 5 different components that are used throughout any of the strategies, right? The first is buying stock in 100-share increments, and then there is selling a call above the strike, there's selling a put below the strike, there's buying a put below the sold put, which turns that naked put into a put credit spread. And then there is buying a SPY, which is a S&P 500 or a QQQ protective put, which kind of protects the broader portfolio, not an individual stock. Now, as you go through this, these components are the same no matter what your strategy is. So for example, every strategy includes the green block, which is the stock, okay? And then the others become a little bit interchangeable, right? So a covered call naked put would include the green, blue, and yellow blocks, and so on. And you can see how you just add these different components to change the strategy up. This building block concept is covered in detail in the videos, but for the purposes of this review, I want to kind of give you a very high-level overview. Bottom line is I'm tracking a number of different variations so that people can, alter the strategy to fit their risk tolerance profile. But when I'm reviewing the performance, I'm only going to focus on the core strategy, which is listed here as the number 1. It's the covered call naked put. And as I've already mentioned, it involves what I'm calling the green building block, which is the stock, the blue building block, which is the call sold above, and the yellow building block, which is the put that is sold below. Okay, now let's look at our open trade update for the entire watch list. We'll start with the trades that are going to expire next Friday, September the 12th. We can see here that our total trades was 22, and our trade win percentage is 95%, versus a stock win rate of 64%. So obviously our option premiums are helping us out quite a bit there. The average stock gain is 2.9%, which is better than the 0.5% for the S&P 500. And right now we're sitting at an average trade gain of 7.7%. So this is shaping up to be a pretty solid week if our stocks can continue to hold here or improve. Okay, for our September the 19th cycle, which would be 2 Fridays out from now, here we had 20 trades on the watch list and a 90% trade win rate, which again is quite a bit higher than the stock win rate, which is just 55%. So once again, our option premiums are helping the profitability considerably. We are beating the S&P with our average stock gain at 3.5% versus 0.2%. And right now, the average trade gain is sitting at 6.6%. So this is actually a very similar setup to what we have in the September 12th expiration cycle. Okay, and finally, our September 26th option expiration cycle. Here we have 22 trades on the watch list. 77% of them still have a trade win rate gain, compared to just a 36% stock win rate. So these stocks are really not off to a great start, but none of them are really doing all that bad. So our overall average trade gain is still 5.3%. However, we do see that the S&P is beating our stock picking for this particular expiration cycle. Okay, that completes kind of the open trade summary. The rest of this presentation is going to be on closed trades. Okay, now let's look at the September 5 expiration cycle, which closed this past Friday. And this is a really nice story. We had 21 trades. 20 of the 21 ended profitably. When you look at both the stock and the options, 76% of the stocks gained, and we had an average stock gain of 15.3% compared to the S&P at 1.4%. Now, admittedly, the majority of that big gain was caused by EchoStar, which you can see here had a 148.3% gain for the 4-week cycle. Fortunately, I did have that particular trade in my account. But if you look at the top three, Oscar Health and and SATS were two of the top three. I had both of those, which made for a nice gain in my personal account. Okay, here is a comparison of the S&P 500 versus the watch list, and this is the entire watch list. On the right, we see that of our closed trades, which would take us through September the 5th, every one but one has exceeded the S&P 500. And then in the 3 open trade weeks, we do have 1 week that is a little bit below, but that's still open, so hopefully that will turn around before expiration. Okay, and then this is a summary of my personal account versus the S&P 500. And as you recall from the September 5 expiration cycle, that did very, very well in my personal account. And I added a little bit over 3% to the cumulative rate of return. So it's now sitting at a little bit over 76% compared to a little under 29% for the S&P 500. I do offer 2 different, very different newsletters to subscribers. If you buy one, you get the other one for free. So one price gets you both newsletters. Of course, this whole video has been over the bull strangle. strategy, which is the stock and option strategy, but I also have a commodity futures newsletter, which specializes in seasonal spreads. You can get both newsletters for the low monthly price of $49, and I offer deep discounts for 3-month, 6-month, and annual subscriptions. The annual subscription actually is a 35% discount. And for a limited time, you can get your first month for just $1. So you can try before you buy.